Welcome, folks. It's Tyler Dunkelberger. I'm here with Dana Dunkelberger, and we've listened to you. We have taken the questions that you have given us over the past couple months, and we've traveled up here to Austin, Texas. We have the opportunity to sit down with one of the lead economists at First Trust, Mr. Bryce Gill, and we're going to ask him those questions that you have brought to us. So, Dana, what are some of the things we're going over today?
We're going to go over the petrodollar. We're going to go over the upcoming election. That's always fun. And basically just get Bryce's opinion on what's going on in the world today. One of the things that we wanted to portray, you hear it from us often, but we wanted you to hear it from one of the top economists in the country. First Trust has one of the top economic teams in the world, actually, and they're right here in Austin, and we can come up and have a conversation with Bryce, and we're here to do it today. Very excited to have that.
All right, we're here, boys. We finally had the opportunity. I want to give a big thank you to Bryce. This is Bryce Gill, Dana Dunkelberger, Tyler Dunkelberger. We have this wonderful opportunity to be here at First Trust today.
Yep.
And we think this is something that we want to bring to y'all on a more consistent basis. So he's an economist here, and so we wanted to kind of pick his brain and get some good data points and share those with you on an ongoing basis so that we can continue to make sure that we're all well educated and we have a good idea where the economy's going.
Yep. First Trust, an incredible company we love working with. And we are told that Bryce is the smartest person at First Trust.
Bye, Bryce.
That's right. I never stop saying it.
Love it, brother. Well, if you want to dive in, I guess we can get right into it. Give us a little background on yourself, and then we'll kind of dive into what's going on in the world today.
Okay, well, great to see y'all again. For everybody at home, my name is Bryce Gill. I'm one of the economists here at First Trust. So I've been working here at First Trust for a little over 10 years. I had the LinkedIn anniversary for 10 years back in like January or February.
Wonderful.
So it's been a while now. I started out, I'm from Wheaton, Illinois, so suburb outside of Chicago. That's where I grew up. That's where First Trust's main office is. We also have a headquarters here in Austin. That's where we're recording from. First half of my career was in Chicago in the suburbs. I was riding the train back and forth from the city. About a couple years before the pandemic hit, I decided I wanted to get out of Illinois. I hated the taxes. I hated the cold. Yeah. I disliked a lot about Illinois, to be frank with you guys.
We're
right?
Iowa boys, so we understand.
Yep, and I just like y'all, I fled the Midwest, and I came down here to Texas. This was around like 2018, so I beat the pandemic just in time. But I've been down here ever since. This is my base camp. I work out of Austin. I live in Austin, but I travel all over the country. I do podcasts. I write. I publish pieces on the blog. We do economic research. I also do a lot of public speaking all over the country as well. So it's I feel really blessed to love what I do. I have an amazing boss, Brian Westbury.
Brian's amazing.
And we got a whole team behind us. We're just talking with Chris Thill, who's producing this thing. Apparently, we're number 3 on Bloomberg right now for forecasting. So,
wow.
Not to toot our own horn, but we're pretty good at what we do.
Kind of a big deal.
Yeah.
And again, we love working with y'all and have great contacts at First Trust. So we're happy to be here and happy to pick your brain and understand where our world is going, because we know you know all.
I don't know about all, but I do have a really great team, and I get the opportunity to sit back and study and try to understand what's going on in our crazy world today.
Yeah. So one of the things that we can kick this off with is just our client base and the questions we get from clients on a regular basis. What's happening with the dollar? Where's our economy going? Where's inflation going? So one question I got recently, and before we, push play today, we were discussing the petrodollar.
Sure.
So do you want to dive into that and kind of give us a background and tell us where you think that's going?
Yeah, absolutely. So, this has been a big question recently. Worries about the dollar go back to 2008, kind of modern worries about the dollar. I guess it's an evergreen worry, but that's when we started printing money for quantitative easing. People got very concerned about the dollar losing reserve currency status. This has recently become a big issue again because Saudi Arabia recently did a press release saying, hey, we're not going to exclusively sell oil in US dollars anymore.
Yep.
Now they're going to accept Chinese yuan. I'm sure they'll accept other things as well. The majority of their trade's still going to be in dollars, but it's no longer an exclusive deal. And so the whole idea of a petrodollar, people that were alive in the 1970s really remember this, I think, and it's been called under question recently. And so the history of this, it goes back to, once again, the 1970s. A couple big things happen with the US dollar at the time. The first is we go off the gold standard under Richard Nixon. Yep. So, in the past, it never really was available for normal people, right? If you're like a major government, maybe you can exchange the dollars you hold for physical gold. But there was always this idea like, hey, if you hold dollars, you can actually get something physical for what you hold, right? There's actually a commodity that backs this up at the end of the day. There's a tangible asset, right? And so it built in like this intrinsic value into the currency. Well, for a whole host of reasons we probably don't have time to talk about today, Nixon goes off the gold standard. The dollar becomes purely a fiat currency, fiat meaning the only thing that gives it value is the full faith and credit of the United States government. This leads to OPEC, realizing, hey, we've got all these dollars that we're getting for the oil that we sell, but those dollars are going, they're not getting us as much in return anymore. And so OPEC sees this happening and they decide to embargo the United States. So the OPEC oil embargo causes energy prices to soar. I believe the price of oil quadrupled during this time period. It causes massive inflation in the 1970s. One of the reasons we had massive inflation. The other was all the money printing happening at the Federal Reserve to pay for the Vietnam War, the Great Society programs under LBJ. But at this time, the administration in Washington, D.C. sees an opportunity to kill two birds with one stone. Okay, they send, I believe, Henry Kissinger over to Saudi Arabia. Yep. He meets with them, and they basically hash out this deal. And the deal comes down to, hey, Saudi Arabia, you're worried about the radical Islamists overthrowing, this like secular monarchy that's in charge. We're going to give you F-16 fighter jets. We're going to give you military and intelligence support to keep you in power. And in return, what you're going to do for us is, one, never embargo us on oil again. This crippled the U.S. economy, obviously. And by the way, this period, this is when the dollar was losing reserve currency status. The dollar plummeted in international markets. For people at home that were alive at the time, people were buying like Deutschmarks at the time. That was like the really desirable currency.
I think that's a good point because a lot of people think, well, this has never happened before.
Right.
Yeah. Not the first time.
Yeah.
Yeah.
And
so
it has.
This has absolutely happened in the 1970s. We were at risk of losing reserve currency status, in my opinion. So, hey, part of it was never embargo us again. And the other part is, hey, you sell your oil exclusively in dollars. And we had this deal with the Saudi Arabians, and it made sense as a deal. And the reason why was, at the time, we were net importers of energy, right? So, hey, we needed to buy oil from other countries. If the country that's selling the most oil and controls the biggest oil cartel is selling their oil exclusively in dollars, hey, it benefits us. It's a win for us. And at the same time, you can no longer exchange your dollars for gold, but now you can exchange it for oil, right? So there's, once again, like an intrinsic value built into the currency. And so for the past, 40, 50 years, up until right around 2013, the United States was a net importer of energy. And we'll flash the chart on the screen for everybody at home that we have that shows the U.S. energy trade balance. But it got bigger and bigger and bigger over the years, right? Up until around 2008, 2009. And then something pretty amazing happens, which is, hydraulic fracturing takes off in the United States. So, Texas and the Eagle Ford Shale, also up in the Permian Basin, also in the Dakotas. Yep. And, in a very short period of time, we're talking 10 years, which in the grand scheme of history is like a blip. Yep. Right? The United States goes from having its largest trade deficit energy ever to being, today we're net exporters of energy, right? And not only oil, but also natural gas. So this totally changed the whole dynamic here. We don't really care about the middleman, Saudi Arabia, anymore. We've been moving away from this deal for a while now, right? Making overtures towards Iran under the Obama administration, also the Joe Biden administration, making overtures towards Israel, getting Israel and Saudi Arabia together in a room. None of this probably would have happened if Saudi Arabia and OPEC had a ton of leverage over us. Today, they just don't really have that much leverage because they're not in charge of energy in the way that they were before. And so, yes, they're not going to sell oil exclusively in dollars anymore, but if you have dollars and you want oil, you don't have to go through the middleman Saudi Arabia anymore. You can come right here to Texas and buy oil.
Right.
So, people look at this as the Saudis sort of leaving the arrangement, and they are. They're sort of backing off this arrangement that was formalized in the 70s, but really we've been sort of backing out of this arrangement for close to a decade now. It looks like the Saudi Arabians are just looking for new partners to sort of hedge their bets.
So where do we go? So when I just, again, going back to our clients and the discussions that we have on a daily basis, and yesterday was a prime example of this. I had a client ask about the petrodollar and how this is changing, and I said, well, tomorrow I'm actually going to talk to Bryce, and I'll have some more insight for you on that. But tell us how this, how do we have a conversation with our clients on, quite frankly, some of them panicking and thinking that, the world's ending, the sky is falling, I guess, is the thing that we're seeing. We want to, we don't want them to panic and go down that dark hole, which I don't think they have to, and I think you would agree with that. So what is that conversation? What do you think that conversation looks like?
Yeah, so I mean, the first thing I'd say, especially if it's regarding like the dollar, the U.S. economy is going to collapse, or like our empire is falling apart, or whatever else, right? The first thing I would say is, this end of the Saudi Arabia agreement, that's because America became a net exporter of energy. That's objectively good for the country, right? It makes us geopolitically more powerful. So how can that be a bad thing for the dollar? It's not really, right? The second thing I would say is, when we talk about reserve currency status, we talk about losing reserve currency status. It's really important to note, like, there has to be a new incumbent or a new rising power to take over from the incumbent, right? So the United States can't lose reserve currency status to nobody, right? And so when you look around the world today, you have to ask yourself, like, who's a better option to be the reserve currency than the United States? China can't really be the reserve currency. One, because their economy is, I don't want to say it's in free fall, but it's certainly under significant strain. The reason why is their population's in decline, right? China's been booming for 50 years because the population's been booming, and then, I'll politely say they've been importing technology from the rest of the world, right?
That's a polite way of saying it.
Now they're in a trade war with the whole world, and their population's in decline. China's in huge trouble. That's even setting aside, billionaires disappear, your property rights aren't protected in China. Europe is easily the number 2 reserve currency in the world, the euro, right? Europe has a ton of significant problems right now. They're the ones having the energy crisis today, right? Russia cut off the gas to Europe. They're sort of having the energy crisis that we had in the 1970s. And it's interesting, and we can put up the other chart that I have for you guys that shows what's been happening with regards to the different reserve currencies. I just have the usage internationally of the dollar and the euro. So this is from an organization called SWIFT. They do all the interbank transfers between countries. So when Russia invaded Ukraine, famously, Russia was kicked out of SWIFT. And what they do is they keep track of what currencies are used in international transactions. So part of being a reserve currency is, hey, we're going to put this in our bank vault, right? And we can protect, if there's a run on the peso, we can sell dollars and buy pesos. The other thing is, hey, if you're like Peru and Egypt and you want to do a business deal, you don't want each other's currencies, you want something you can trust.
Yeah.
And so it's what dollars are used in, what currencies are used in international transactions. And so what's interesting is ever since the invasion of Ukraine, this is when, once again, this became a huge issue. It's been like an evergreen issue in the news, the reserve currency status of the dollar. The dollar's actually gone up slightly in usage since the invasion of Ukraine. I think that surprises a lot of people. Not a lot, like 2-3%. The euro has fallen off a cliff in usage. The euro is the one having the reserve currency crisis right now because, energy crisis, and there's a war on the continent. And, on top of that, will the European Union stay together? Nobody really knows. Great Britain's left the trade union. You've got, the Southern European countries thinking of leaving the currency union. So the whole thing, it looks very shaky at the moment.
And I think of some of the headlines that you read is, the concern that the BRICS nations are going to come in and be reserve currency.
Exactly sure.
Right. I think one of the last times we were talking, you pointed out the fact that look at the leaders of all of those countries.
Yeah.
And then tell me that they're going to sit and agree all the time.
Exactly.
Right. So.
Yeah, and that's 5 countries in BRICS. And BRICS, once again, that comes together. I believe Goldman Sachs actually invented the term BRICS because they put together like an emerging markets basket that they were selling. And this is a way to like brand it.
Yeah.
This is back in 2008, once again, when everybody's worried about, the dollar and the money printing. And it's, on again, off again, been a news story that they're going to put together a reserve currency to compete with the dollar. Nothing's really happened there. And then you have to ask yourself, yes, I mean, how are these countries all going to agree on this all the time? It would just be dominated by China. Why would Russia or Brazil really agree to that? They probably wouldn't. And then at the end of the day, I mean, a lot of things give a reserve currency value, or just a currency in general value. I think one of the biggest advantages the dollar has is the property rights that you get alongside the dollar.
Yeah.
You can't just seize somebody's personal assets in the United States very easily, like you could in Russia, for example, if you go against Vladimir Putin, or in China, if you go against Chairman Xi, right? The billionaires disappear in China all the time. So there's just not really a competitor for the United States on the world stage that can take over this responsibility. When you look how reserve currencies shift hands over time, we took it from the British because they bankrupted themselves in 2 world wars. Before the British, it was, the French. Before the French, it was the Portuguese. Before the Portuguese, it was the Spanish. This was, there's always some big like military disaster or like
History repeating itself.
Exactly.
Yeah.
And so there would have to be some significant disaster for the United States to potentially lose it. And, I don't see the rising power that's about to take us down. Fundamentally, nobody can really compete with us on, population, productivity, the size of the economy. We have the most fresh water in the world. We're energy exporters. We're food exporters. We have 2 oceans. We have 2 friendly neighbors. We have the best military. I mean, there's a lot of things that give us natural advantages.
Yeah, I didn't think about the property rights side of that, and I don't think anyone else thinks of that, or our clients for that matter. Right. I mean, obviously you do.
Well, I think there's a lot of people that look at the headlines. They're getting a glance and an idea from a headline and not absorbing, the entire picture.
Right.
And headlines are right now opinions.
Well, yeah, and that's the media doesn't obviously focus on the picture. They focus on what sells.
Right. What gets clicks and what sells.
Yeah, and I think that's an important thing to say is like, I'm an economist, right? So like the economics of the media ecosystem in the modern world, it rewards engagement. Like you got to keep people engaged in consuming your content because then you can sell them ads, right?
Right.
And
Which the dollar going away is going to get people to click.
Exactly. And, there's been nearly 100 years of empirical evidence now in psychology saying that negative news has about 4 times the impact of positive news with regards to engagement. And so there's an incentive to sell you negativity, to keep you anxious, to keep you scared, because then you watch and then they can sell you ads. And that's from cable news all the way down.
Right. Yeah, and that anxiety is pushed even more now with the election. So
sure.
Let's talk about that a little bit. So I would kind of agree with your opinions on this, but give me your opinion on how this election is going to affect the economy.
Yeah, absolutely. So, when we look empirically at history around elections and like investment returns, right? So I'm making a pretty narrow, claim. I'm just talking about how it's going to affect your portfolio at home, right? This election. Elections tend to be very high drama, but they're pretty low impact on like the stock market or stock market returns, right? Mm-hmm. So every election nowadays is, once again, it's spun up to be the biggest, most important election of all time. And like, sure, you could like make the case that that's maybe true, but generally speaking, individual presidents do not have that big of an impact on the stock market overall. I think that the stock market is driven much more by economic fundamentals surrounding like demographics, productivity, and then you could add like geopolitical events that really shift government policy in a significant way. The important thing to remember about elections in general and the way our government functions, is this is not 1776 anymore. Okay, there's a permanent bureaucracy in Washington, D.C. The federal government has 3 million employees. We as American citizens, vote for about 1 to 2% of those employees. Yeah. So that means 98% of who runs the federal government is there year after year after year, no matter who gets elected as president or senator or whatever. Okay, and so there's a lot of institutional inertia that drives government policy. That's just the reality of it. And so, Donald Trump gets in 2016. He makes a lot of arguments about bringing business back to the United States, bringing back manufacturing, starting a trade war with China. We need to be less reliant on China for imports. Most of this was bluster. It was just talk. It resonated with a lot of people, but frankly, like the economic policy didn't shift significantly until COVID-19 hits, right? Yep. A virus comes out of China that then disrupts these really long, complex global supply chains. Now, all of a sudden, what's really interesting is the Democrats and the Republicans are basically right next to each other with regards to bringing manufacturing back to the country, reshoring production, getting supply chains shored up, right? So it wasn't the election of Joe Biden that changed that. It was COVID that changed that. It was a major geopolitical event. And so I think elections just do not play as big of a role as and maybe, the founding of the country says they should play a bigger role, right? But just in reality, they don't currently. It's demographics, it's productivity, it's entrepreneurship, and it's major geopolitical events that really move the needle.
So that being said, what do you think the volatility and the interest rate volatility is going to have an impact on the markets?
Yeah, so markets have been extremely volatile over the past few years because we've seen so much interest rate volatility. And for people at home, the value of your financial assets it comes down to profits and interest rates, earnings and a multiple, right? That's how everyone on Wall Street, every financial advisor, everybody values assets that way. And so when the interest rates drop to zero, like they did during COVID, and then the Fed hikes interest rates at the fastest pace they have in 40 years, that's going to cause portfolios to bounce around rapidly. And so, we just got a really good inflation report today. Inflation fell.
Yep.
Okay. Now, I personally believe inflation is going to be sticky, and our problem's not over. But even setting that aside, okay, maybe the Fed is able to come through with a couple of rate cuts here. The reality is, for the past 30-something years, there's been what's called like the Fed put in the market, right? Which meant, hey, like we cut rates when the market or the economy is not doing well because there's no downside to doing that. We just stimulate. There wasn't inflation for 30 years,
right?
Okay. Well, all of a sudden COVID hits, there's all this inflation. The Fed's no longer able to step in and like intervene in the same way. So we have a recession, whatever, the Fed's not gonna be able to cut to zero. So the Fed put is sort of gone, would be the argument that I would make. The Fed has been the biggest buyer of US Treasury bonds for the past 15 years, right? They had a huge thumb on the scale. And so they essentially controlled the whole market. Now we're in a situation where, the Fed can maybe come through with like a couple token rate cuts here, but they're not able to step in and, buy the majority of US debt issuance anymore. And US Treasury bonds, guys, the reason these are important is that's the benchmark interest rate for the whole economy, right? Like where the US 10-year Treasury is at, every other interest, your car interest payment, your mortgage, everything's built on top of that. And so what I think is going on with interest rate volatility is essentially you've had this big thumb on the scale, this like steady hand on the wheel, kind of controlling the volatility of interest rates for as long as I've been in the industry. Right, and now they've stepped away fully, and market-based forces have returned to U.S. Treasury yields again. Yeah. And so nobody's really like traded these things in a market-based environment in at least 15 years, but probably even longer than that, right? Again, the Fed put, the Fed savior was always there, and so hey, we have all this volatility, especially at the long end of the yield curve, and I think that's going to continue even if the Fed cuts.
Yeah, well, and that's the question too. Will they do any meaningful cuts, or is it going to be a quarter basis at a time?
Yeah, I think they'll be able to maybe get like one or two rate cuts in there, but like real interest rates are going to stay positive. If you adjust rates for inflation, they're still going to be positive, right? We're not going to be back to this zero interest rate, negative real interest rate environment that we've had for, again, 15 plus years. And so that means markets are going to keep bouncing around. We're in a volatile period with regards to the market because the Fed's just not there to save us anymore, right? So volatility is going to continue, in my opinion. There's a lot of good things happening with the U.S. economy, frankly. I think we like all this geopolitical chaos, a lot of it is going in our favor. But when the market looks at everything, free money was a major underpinning of market performance after 2008, and free money's gone.
For a long period of time here.
and then recently a massive influx during COVID.
Yeah, it's amazing what happens when they print $6 trillion.
Is that the number?
It was like, $5 to $6 trillion they created out of thin air. And, after 08, 09, we just stuffed those into bank balance sheets. So we created a lot of money, but like normal people didn't get their hands on any of it. COVID, what we did was we printed all the money and sent checks to everybody in the country, right?
Yeah,
so
whether they needed it, wanted it or not.
Exactly. Yeah. So that's why we saw so much inflation post-COVID that we didn't see after 08, 09.
So the other question I get and concern, because we deal with, we do retirement planning. So now it's, Dana, I can't believe how much I'm paying at the grocery store and things like that. I can't believe how much I'm paying for gas, even though, maybe it's not as high as it was in the 70s.
Right.
So what's your thought on that? What's your thought on real prices, gas and food? Do you have any opinion on that direction, or is it just volatility is the norm at the moment?
Yeah, so I'd say was like the baseline inflation, what's like the status quo that's in everybody's heads in our industry, but also like, what I think everyone was used to is 2% inflation.
Right.
Mm-hmm.
Okay. So the mainstream sort of view of that is that Paul Volcker raised interest rates to 20% and broke the back of inflation. That's why we had 2% for 30 years. I don't think that's why. I think we had 2% inflation because, globalization exploded. Mm-hmm. Russia, the Soviet Union collapsed, China joins the WTO. We get access to cheap labor all over the world, and we can arbitrage it. We've got standardized container shipping, we've got the internet, right, in a way we'd never been able to before. Mm-hmm. And so that keeps inflation low for 30 years. Now all the cheap labor is drying up, populations are peaking, geopolitics is very risky. These long, supply chains look dangerous to companies. And so globalization is sort of reversing. So I think that raises the baseline level of inflation. Maybe it's not 2% anymore, maybe it's 3%. Remains to be seen. Maybe AI and automation and all that steps in here and really helps get, all this under control. I haven't seen evidence of that yet, but, I'm sure it will work out eventually. But, people have to understand that COVID was like this catalyst that took like a 30-year trend and completely flipped it on its head, right? And so there's going to be volatility. There's going to be reverberations through the economy from that. The upside is we become more self-sufficient as a country. Normal people aren't competing with someone in China making 5% as much an hour anymore, right? So their pay is actually rising more rapidly. Baseline GDP growth is probably faster, more investments happening here. We're a capital magnet for the world, but we probably do have a higher baseline level of inflation as well. And I know we focus on like groceries and gasoline, but you look at the economic data and those have actually held down overall inflation in the past year, right? It's like services costs.
Yeah.
So the cost of a cruise or a haircut or whatever else, those are what's really driving inflation right now. It seems like some of those pressures are easing up a little bit.
Agreed.
Right, yeah. But that's all driven by wages. The price of oil goes up, it comes down. You raise someone's pay, like, I was at Chipotle here in Austin the other day. It was $12 an hour before the pandemic. It's like $20 an hour to work at Chipotle now. They're never going back to paying $12 an hour, right? So it cements this higher level of...
And lunch is not going to cost $10 anymore. It's going to cost $20.
Exactly. So the prices you got used to are never coming back. Yep. There's a new higher price level. That's because we printed $5 trillion during COVID-19. And I think prices are still going to go up and probably at a faster baseline rate than pre-pandemic as well. So it's not going to be, 10% a year. We're not Argentina.
Right.
But maybe it's 3% instead of 2%. And you do financial planning, you understand that sounds like a small number to people, but, rule of 70, right? Like the loss of purchasing power, the difference there is fairly significant. That's just 1%.
Well, 3.5%, you lose the value of your money cuts in half in 20 years.
Exactly.
So over your retirement at 3.5% inflation, your money's worth half.
Yeah. So, and obviously we work at combating that and helping our clients through that. And so that's why we rely on First Trust a lot and love working with y'all. We're probably at a good point to wrap. What do you think, boys?
Yeah, I think there's a lot of data to digest, a lot of information there. We appreciate it. Appreciate your time.
Absolutely, guys.
Yeah, it's been great. Thanks, Bryce. And hopefully we can do this again soon and make it, a regular thing. Because I know our clients want this information and we can say it out loud, but obviously you have the background and expertise to, back it up and really do a great job explaining it. So Thank you so much, brother. We appreciate your time.
Absolutely, guys.
Have a great rest of your day.
All right, guys. Thanks so
Awesome.
much.
Thank you.
Yep.
Perfect.